guys. We've been getting a lot of questions lately asking for tips on how to buy and effectively manage an investment property. So today I'm joined with Sam Hyman, Lendi's Insight Sales Director, just to share with you guys some of his tips on how to make the most out of your investment property. So welcome, Sam.
Hi, how you going?
Yeah, we're really good. Let's just dive straight in. We know that purchasing an investment property is one of Australia's favorite ways to invest, but there's always a risk when it comes to choosing to go down that property investment route. So, what would you say to property investors to take into consideration when they're choosing a property to invest in?
I think the most important aspect is to really understand what are their goals that they're trying to achieve out of investing in property. I think a lot of people, throw out the statement around, purchasing an investment property, but without really considering their long-term impacts. I think any type of property investment is a typically a longer-term investment. You're anywhere from 3 to 10 year investment. So I think it's really important for them to understand what they really want to achieve out of it. For example, are they looking to invest in an area where they're going to be able to gain capital growth over a period of time, or are they looking to invest in a property where they could increase their income and look for more of a higher rental yield property? So yeah, I think it really depends on the goals of the actual investor.
So awesome. Tip number one is obviously gather your goals when it comes to finding an investment property. Sam, what would you say would be your tip number two?
Yeah, so I think once you have an understanding of what you actually want to achieve from this investment purchase financially, I think it's really important again to then relate that back to what you know. So you see a lot of people get caught up in the hype of up and coming areas, off the plan developments that are promising really high rental yields, and that can see somebody entering into a investment path in an area that they may not be as familiar with. So I think another aspect of it that's really important is to, from a geographical perspective, make sure that you have done enough research and are familiar with the area that you're looking to invest in. Because again, that can really depend on and relate to your strategy in terms of the overall risk that you're looking to expose yourself to. Because often some of those higher return promising investments can often be some of the highest risk as well.
So some great tips right there, Sam. A lot of property investors do also base their purchase decisions on tax deductions. Is this something that you personally would recommend? And what would you say to investors to pay attention to avoid that risk of being unable to manage their mortgage repayments?
Yeah, look, I think the first thing, if we're looking at mortgage repayments as a separate issue, I think the first thing is with any investment property, you've obviously got the risk of that being vacant for a period of time, depending on, we've just gone through in and out of a pandemic, which saw, really different levels of vacancy rates in specific properties. So make sure you're educated in terms of what this could cost, and ask yourself the question: if this was vacant for a period of 4 weeks or 3 months, could I afford that, or would that be something that threw you over the edge? I think is a really important consideration. Cash flow management is obviously a really important aspect. Typically, though, from the tax deduction perspective, I think again it's all about educating yourself and making yourself aware of the taxes that are involved, or the tax benefits that are involved in purchasing an investment property, which obviously you'd be able to get specific advice from your accountant. So I think one of the other really important considerations are obviously the benefits, and negative gearing is something available to investment property holders that can really see some great tax implications if it's structured the right way. Properties that come with depreciation schedules that can really add a lot to the negative gearing and your tax adjustment at the end of the financial year.
So, gather from what you're saying, we should really be paying attention to obviously vacancy rates and just managing your cash flow, as well as noticing those tax benefits. And some investors may want to purchase an investment property using equity from another property. I understand that the loans can be structured in also many different ways.
Yep.
Can you explain a little bit more about this?
Yeah, look, I think accessing equity from an existing property is something that a lot of investors use to access the deposit, and I think really take advantage of the equity that they've built up in another property. So I think typically that's quite a straightforward transaction, especially on the refinance side. to be able to access that equity or the amount of deposit that's required for that new purchase. So yeah, accessing equity from a different property is certainly an option that a lot of property investors use to get that initial deposit required to be able to put them in a position to purchase an investment property.
Ah, brilliant. And finally, Sam, what advice would you give to investors on choosing the right type of mortgage? There are many options on the market and home loan packages being offered by banks at the moment. Should they choose interest only or principal and interest loans? Should they go for fixed or variable? What's your take on this?
Yeah, I think it's a great question, and I think it's something that often there's typically a lot of confusion around from property investors. So I think in terms of my previous answer, one of the really important factors of mortgage is, again, depending on the structure and the advice given from your accountant. So if you were accessing equity from a different property, for example, you would want to have that as a separate loan split on that loan, so that at tax time, it's very easy for your accountant to work out the interest cost at the end of the financial year. And I think the other part of that, around getting the structure right in the first place, comes back to the original point around making sure you've got the right goals in place. If it is strictly a cash flow goal, then an interest only option is something that can be of benefit, because obviously there's less outgoings on that property month on month, and you can increase your cash flow available to cover off that mortgage. I think in terms of interest only, it is typically quite a popular loan structure choice for investors. The reason being as well is how it relates to negative gearing. Because if you're only paying interest on the loan, your balance isn't reducing, which means your interest bill is higher at the end of the year, and you have a greater negative gearing balance. Now, when it comes to fixed versus variable rates, that decision really comes down to the flexibility that the property investor wants. So typically with fixed rates, you're capped at your additional repayments that you are able to make into that loan. And what that means, again, depending on the goals, is it could stop you from, paying down that balance faster. However, on the flip side, if you are somebody who was purchasing investment property and wanted the security, at least you know what your repayments are going to be over that set period of that fixed term. Now, flipping that over to a variable rate, that gives the investor, full flexibility. Typically, variable rates, or the majority in the market, have unlimited extra repayments, and have, offset accounts that can be linked for, again, that can have separate tax implications that you can work through with your accountant.
Well, certainly there's a lot to unpack right there, and some really valuable insights. So thank you so much for that, Sam. For those who are looking to purchase an investment property, we hope that you found those tips useful. And if you're currently looking to purchase a new property, jump onto lendi.com.au. We have 35 different banks and lenders on our panel that you can compare rates online and also apply. And we also have a team of home loan specialists who can help you at every step of the way. That's it for today, guys, and thank you very much for being here.